Well, hey there, everyone. Rolling up the sleeves, getting ready for the show today. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from a beautiful fall day here in Redmond, Washington. Hope you guys are all doing well and hanging in there. Just off camera, I am definitely not watching Game 4 of the American League Division Series with our hometown Seattle Mariners taking on the Detroit Tigers, with the opportunity to put this away and play for the pennant. Would not dream of distracting at all from the charts and our discussion. So I'm putting the minimal amount on that and most of my attention with you. And thank you guys so much for tuning in today. If you're new to the show, welcome. Those of you tuning in live, you have the opportunity to ask questions all along the way. It's great to have an interactive group of viewers here every trading day chatting about the markets and asking questions. We're live streaming on Facebook, LinkedIn, YouTube, and X as we go along, as we recap the markets, as we look at the heat map together, as we highlight some charts of interest. Please drop questions wherever you're seeing the live stream. I'll be looking for those questions. Take a question or two at the end of the episode. Anything else that we don't get to, we'll put in the mailbag. We've got a mailbag episode lined up for this Friday. We'd love to answer one of your questions there. As you can see the message on the bottom of the screen here before we get to the markets today, I will be at the Orlando Money Show next week. You can find more information at marketmisbehavior.com/money show. Please, if you're going to be attending, come say hello. I'll be presenting, I think, on Thursday morning, I believe. Although my calendar, I don't have briefly in front of me here, but I'm pretty sure it's Thursday morning that I'll be giving a presentation on the 4 pillars of investing success. I have a series of podcast interviews that I'll be doing from the exhibit hall. I actually have a booth in the exhibit hall, so please find me in one of those locations. I'll be somewhere along those lines, and I'll hope to meet with some of you in person. Always a pleasure to do so. Let's talk about the market conditions here. I mean, this uptrend just continues, right? The pattern of higher highs and higher lows appears to still be in good shape, and you can see that by the fact that the S&P accelerated out of the open, hit a basically an intraday high right around lunchtime, right around noon Eastern, had a number of retests of those highs through the course of the day, and indeed finished right around the highs for the day, just above 67.53. That's enough to make the S&P up 0.6% today. The NASDAQ Composite up 1.1%. The Dow flat, dead even. So this is pretty interesting, right? Look at this chart here on the left. This is a little preview chart. The Stock Charts platform has a little 2-day preview, which I like a lot. Shows you what happens today, but also how that relates to the previous day. Good to just get a sense of one day to the next, sort of understanding the relationship between those two. A lot of times yesterday's close comes into play, which is why I have that here with a blue horizontal line. There's an NASDAQ Composite. Big surge in the first 30 minutes. Nice consistent uptrend through the remainder of the trading day. Here's the S&P 500 with a very similar surge in the morning, but then kind of tapering off and leveling off into the afternoon. And look what the Dow did. They all had that same surge out of the open. So all 3 indexes kind of looking the same, but then the afternoon is where they completely diverge, right? Sort of that growth over value trade, not as much happening in the morning, but by the end of the day, you could see a big gap between the NASDAQ and the S&P. Now, what you'll find as we look at the sector returns in a little bit, it was all about technology. That's really what drove the NASDAQ to outperform these other indexes. But this is one of those times where there's quite a bit of a divergence, and it tells you really where the leadership is. Mid caps and small caps had a decent day as well, by the way, up 0.9%, 1% for the small cap and mid cap indexes. VIX about a full point lower today. The VIX down around 16.3. That's down from the low 17s that we were in yesterday. So we've seen a general uptrend in volatility. Today's move just reminds you we're in a low volatility environment. Markets moving higher on lower volatility. That is a kind of classic bull market configuration. What's great about that is at some point that won't be the case anymore. Keep watching the show. I promise I will do my best to highlight when those conditions change, when we experience a change of character. For now, it appears that the trend in the markets continues to be higher, at least for equities. Looking at the bond markets, kind of mixed results here. You can see the curve was essentially flat today. Not a lot of movement across the yield curve. We've been seeing yields generally drifting lower, but here we're actually getting kind of a stabilization. And, bonds actually opened stronger, but traded lower through the course of the day. The dollar, not much of a change either. So I'd say for the fixed income and currency markets, not a huge day. Big day, though, in the commodity space. Look at gold pressing new all-time highs, up another 1.7% for the GLD. Silver up another 2.7% today. Someone mentioned in the chat, I noticed the analysis of the gold markets. We did that for Stock Charts TV. I think that was posted yesterday. Please head over there when you have a moment. Check out that latest video. We talked about gold from a couple different angles, sort of the long-term history of gold, some of the medium-term movements, and then short-term acceleration and trend, how to think of it from a trend-following perspective. I still, as I've mentioned many times, have a decent position, GLD, IAU, to continue to play that upside. It's become a bigger and bigger weight, and that's, I've kind of been okay with it. Ray Dalio, I think that was this week, did a thing saying investors should have about 15% of their portfolio in gold. It's probably become that big. If you didn't intend it to be, I would check your statements and see whether that's become too much of a weight. But I know for me, it's definitely helped my returns in 2025. Natural gas prices a little bit lower, but the rest of the commodity space kind of doing okay. Cryptocurrencies, the price of Bitcoin got down around 121,000 yesterday. Today, kind of rotating back higher. Got to as high as 124,000 earlier today, Eastern time. Currently trading about 1,000 points below there, around 123,000. So we are at or near new all-time highs, which were just here recently this week, around 125,000. Charted Bitcoin pretty constructive. Charted Bitcoin ETFs pretty constructive. When I apply my market trend model to those markets, they're bullish on all time frames. Again, it's fascinating how gold and Bitcoin have gone higher. It feels very much like a safe haven trade, and certainly appears to be. Investors of some decent size would be my guess, right? Would be my assumption. Instead of going into the dollar strengthening, you're seeing strength in gold and Bitcoin instead. But interesting that that's happening as equities are at or near new all-time high. So one of those has to change at some point, I would assume. One of those three is no longer going to be in a primary uptrend, but for now, those trends are all in pretty good shape. All right, oh boy, the Tigers just hit a home run. It's my fault. I blame myself for mentioning I was watching the game during the show. That's on me. That's karma. All right, we'll continue on here. The technology sector, top of the leaderboard, up 1.8% for the XLK. Industrials, number 2, up 0.9%. Utilities, up 0.7%. So right at the top, 1, 2, 3, we have the growthiest of growth in technology, kind of a value leadership play in industrials, and then more of a defensive sector, utilities, all at the top of the leaderboard. Now, to be honest, utilities are sort of a growthy play. A lot of the strength in utilities has been attributed to the incredible energy needs or energy requirements of AI-related activities. They all require a lot of power to fuel those awesome AI things. As a result, utilities have become a bit of a growth engine and diverging a bit from some of the other defensive sectors that have remained in a position of underperformance. If you look at the sector returns today, about half and half, right? 6 of them up, 5 of them down. On the downside, you can see the energy sector, the XLE, the worst performer, down 0.6%. Real estate and consumer staples, both down about 0.5%. Those are your worst performers today. Breadth conditions, not bad, right? We've been talking for a while now about the deteriorating breadth, the lack of breadth support, the fact that the S&P and the NASDAQ have been propelling to new all-time highs, but not supported by stronger breadth readings. We have a couple charts to show you to talk about breadth. Yesterday, we talked about the McClellan oscillator remaining below zero here since mid-September. We're continuing to see that here in early October with the short-term breadth negative. Today, a bit of a change there. You can see on the S&P 500, 53 to 47. On the New York Composite Index, 59% advancers to 38% decliners, about a 2-to-1 ratio in the mid-cap index. So, not exceptionally strong, but certainly not weak and changing from some of the weaker breadth conditions that we've seen. Stocks like AMD gapping higher, continuing to accelerate to the upside. Also, technology names like Dell up another 9%. Those are your top 2 names. Arista Networks, I think I grabbed to review later, but that's up about 8% as well. Looking at the Magnificent Seven and Friends, kind of these leading growth names, you can see Broadcom number 1, up 2.7%. Broadcom, I would argue, is a key chart. The three of these that I think are most compelling. I mean, they're all important. Don't get me wrong. They're all important to watch, which is why I have them as a group. But in terms of priority, I would say the trifecta of Broadcom, Meta, Amazon, all three of those have made new highs and now are pulling back. They're all testing support. They're all testing a key moving average, a key gap support, a key level that as long as that level holds, conditions are good. But if that level does not hold, the chart starts to look a lot less awesome very, very quickly. I think Broadcom very much at that point, testing gap support, bouncing today up 2.7% after testing that level here recently. NVIDIA is another one because NVIDIA is actually one of the only one, might be the only one on this list as I'm glancing down through them. It's actually making a new 52-week high this week. NVIDIA is right at the upper end and actually just breaking out above resistance. That's the strength in technology. These two names up so much is what's propelling the XLK to the top of the leaderboard. Only name not doing well today is Alphabet, continuing to kind of limp through the last 3 weeks, right? Lower highs, lower lows in the short term as we pull back from those previous highs. All right, let's check out on the heat map. By the way, thank you so much, Tony, for the very kind gesture. And I appreciate your comments about bringing you education. I'm happy to do it. Hopefully you pick up on the fact that I very much enjoy doing the show. I enjoy teaching investors how to make better decisions. I was talking to a friend of mine, Chris Diodato, who's a wealth manager based down in Florida. I've kept in touch with Chris from being a student at Penn State many years ago, and randomly have checked in with him, and a mutual friend reconnected us, and I had a really good chat. And we were talking about conditions here, and just the fact that it's so important to have a good process, right? A good, consistent process, but also to enjoy what you're doing. And we both were reflecting on the fact that we find some things that we're really enjoying doing, and I think that's what's so valuable. I hope you're able to find that in your work as well. All right, let's look at the heat map here, the market carpet, as it's called, on stockcharts.com. I don't know what your impressions are. I would encourage you to take a moment to look around. But as I'm reflecting here, I'm seeing some areas of strength and certainly some areas of weakness. Not hard to quickly hone in on the two sectors outperforming the rest. You have technology in the upper left corner, industrials in the upper right corner. Let's start with technology. I mean, it starts with the biggest names here, right? So while Microsoft sort of, just stalled out here, Apple stalled out as it's trying to make a new all-time high. We have NVIDIA up another 2.2%, re-exerting the breakout above 180, 185, continue to make higher highs and higher lows. That's a strong upswing. Broadcom, as I mentioned, bouncing higher after that pullback. And I like the strength that we're seeing there in the short term. But it's a lot of other places as well. Names like Micron, we highlighted yesterday, pretty big pullback in the semiconductors. A lot of those names moving right back higher today, right? Applied Materials and others pushing to the upside. F5 Networks, FFIV, up 3.6%. That's a new all-time high for another technology name. There's a bunch of names here as you flip around that have very constructive charts. And what's interesting is, while it feels like this sector is so overextended, which arguably it very much is, you also find a lot of names that are a little earlier on just starting to rotate higher. And I think that's the encouraging sign, right? Some names that have been, pulling back that have not been breaking out. A name like Cisco that's been more sideways for the last couple months. That's where the opportunity can be if those actually start to rotate to the upside. So nice day for technology. Besides KLAC pulling back off of a test of highs, IBM pulling back, trying to make it above the summer highs. The rest of technology looking pretty decent. In the upper right corner, we can see Caterpillar looks kind of like a tech name, right? If I covered up the ticker and ask you what sector, personally, I'd probably guess technology, right? It looks like a growth stock. It's the other kind of growth. It's the old school cyclical growth. So you have on the same day that F5 Networks is pushing new all-time highs and AMD is resuming its uptrend, you have Caterpillar and Northrop Grumman, about as old school kind of cyclical leadership in industrials as you could come up with, breaking out as well. So it's not everything, right? Not everything has this position of strength, but charts like this in my opinion, deserve the benefit of the doubt. I always like to describe charts as innocent until proven guilty, or guilty until proven innocent. And these are charts that are innocent until proven guilty. They're strong charts kind of getting stronger. Let's talk about the areas of the market not looking particularly good today. Obviously, some of the defensive sectors like consumer staples and real estate, with plenty of red in there. Within consumer discretionary, I'm noting, gambling stocks, for example, MGM, Wynn, are all stocks that are struggling. MGM stands out to me because not too long ago, end of August, I remember highlighting MGM as a potential, really bullish chart because it was finally breaking above the July highs after it tested the 200-day. It looked like this really good setup before a breakout, but no real follow through after that break above the July peak. Then we had a couple bounces off the 200-day moving average. This week, we're actually breaking below the 200-day. So, excuse me, that's a stock unable to hold up on those gains and now starting to rotate more to the downside. Also looking at the financial sector, and these charts are not horrible, right? I mean, the chart of JP Morgan is not a horrible chart. From a trend following perspective, we're still making higher highs and higher lows. We're still above an upward sloping 50-day moving average, but we've broken the 21-day EMA. So it's telling me in the short term, we're seeing some tactical weakness. Still okay on the long term, right? Because they're still making higher lows. We're still holding the 50-day. The RSI is still holding 40. But this, for me, if I hold a name like JP Morgan, which I don't, but if I did, I'd probably be putting that on another watch list of potential breakdowns. And I'd be thinking about what would I need to see on this chart to start to get out of the way and maybe change my position. I think some of these financial names that have had pretty good runs, stalling out a bit, maybe worthy of being put on that list. Citigroup's another one, right? Making a break above $100 a share, now back below there. I think that's it on the heat map. Again, tech and industrials really impressing today. Financials kind of stalling out after setting up in a pretty positive way. We'll see if that's able to continue, but for now, not really working. All right, let's look at some charts together, shall we? Here's the S&P 500. Again, by any stretch, by any definition of trend following, this is a bullish chart. What makes this a bullish chart? Higher highs, higher lows, upward sloping moving averages. The lows in particular getting higher is what's so meaningful. And that's what I think has been, really striking as I look back at the end of this year and think about what the experience of 2025 was. I think just trusting a market where the pullbacks in an uptrend just keep getting higher, I think is so powerful. And that's what we're seeing here with the S&P 500. So the new all-time highs this week don't impress me as much as the fact that when we pull back, we're not undercutting the swing low. And so what that means is in some ways it's a pretty easy market because we just keep bumping up our stop. And if we make a higher swing low, that'll be the next initial stop. For now, that initial stop for me is around 65.50. I think any pullback that holds that level is pretty good. That's also the 50-day moving average right about there. I think anything above there is pretty much gravy at this point. That's all good. And I can tell you a bunch of reasons why the market could go lower. But as a trend follower, I'm more concerned with defining and recognizing the fact that the trend is clearly positive and it is. S&P's actually right barely at the overbought region, not quite up there today, but something to watch as we continue on through this week. Next chart, we'll talk about the advanced decline data. Two charts about breadth that I think I grabbed. We highlighted yesterday the McClellan oscillator, which is derived from the advanced decline data. This is a kind of basic breadth approach, just looking at how many stocks are up or down one day to the next by making a cumulative advanced decline line. We look at the trend in those advanced decline lines over time. The New York Composite AD line is the one that I follow the most. This uses common stocks only. Worth noting, this AD line has been dead flat since the end of June, right? End of June until the beginning of October, the cumulative advanced decline line has gone sideways. So while the S&P has been making new all-time highs every one of those months, while the NASDAQ 100 has been making new all-time highs in July, in August, and September, the advanced decline data on the New York Stock Exchange has been sideways. So that's when I talk about a lack of breadth support, that's it. Now, in the large cap space, the S&P 500, the AD line did make a new all-time high earlier this month, right, in the last week. The mid cap and small cap AD lines have actually all been trending lower, and they're all below their 50-day moving average. So we're getting quite a bit of a divergence here with the S&P going up and more of these breadth lines not going up, right? At best, kind of sideways, and at worst, starting to trend lower. This has to resolve itself in one of two ways, right? That trend doesn't continue forever. Either the S&P breaks out and the breadth improves, which supports that, or the S&P finally feels the weight of that weaker breadth. But this divergence basically is a big red flag in my mind, saying the S&P is going higher, but the breadth support just really isn't there right now. We're also seeing lack of breadth support in the percent of stocks above their 50-day moving average. It's currently around 56%, which is not a horrible reading. That's actually okay. And as long as we hold 50%, as we did at the end of July, as we did at the end of September, conditions are still pretty good. If we would break below 50%, which is likely to happen at some point, that would be kind of a negative sign, and certainly suggesting a lot more stocks are breaking down than the indexes would reflect. We're definitely seeing that same divergence as we saw with some of the advanced decline lines. I'm showing you that here from the end of June through the end of September and now into the fourth quarter. Every new high has been marked with less stocks in the S&P pushing back above their 50-day moving average. Now, again, the market can go higher for months on weaker breadth, as we've seen in the last month, in the last couple months. But at some point, that has to resolve, and I think that's why it's important to continue to watch here. All right, let's look at some individual stocks. We'll take a couple questions. We'll call it an evening. Looking at Arista Networks, ANET. This is in the telecom equipment group in the technology sector. New all-time high today, pushing above $157 a share for the first time. I'm noting here these pullbacks to the 21-day exponential moving average, one of my favorite kind of initial stops. When you have a chart that's working, when you have a chart that's going up and to the right, you look for those pullbacks to 21-day EMA. It's just an initial stop, right? An initial sign that that we're having a pullback, but it's still good. Anything below the 21-day EMA, I think you have to start to question, all right, is this the beginning of something more significant? For now, that's been holding. We're resuming the uptrend. We're making new all-time highs. A follow-through day on Thursday confirms that uptrend. Watch the momentum, right? Because these uptrend moves, these higher highs, have been marked recently by stronger momentum. If we would make a new high and the RSI would stay below 70 here this week, that would be a bearish momentum divergence, could suggest an upside exhaustion. Not there yet. The biotechnology sector. Oh, I completely butchered these charts. Hold on a second. Let's look at the daily chart of the biotech sector first. Here we go. The biotech ETF looks a little bit like Arista Networks, right? These pullbacks to the 21-day EMA. Look at all those tests along the way, but now starting to reaccelerate to the upside. We're overbought again, but that really punctuates this this uptrend. But I immediately looked to the left and saw that 150 was a pretty important level. Those are the highs from July, August, September, November of 2024. So we go back to the weekly chart. So as we talked about on yesterday's show, right? When in doubt, zoom out. Look at a little bit more data. Here we can see those highs from mid-2024. We can see how the sell-off to the low in April basically took the biotech ETF IBB down to the 2023 lows, really back down to the 2022 lows, sort of a triple bottom pattern there. We go back and retest the highs. And now over the last week or two, we've finally broken above that level. That level is also pretty important because if you look at that 2021 to 2022 sell-off, look at the initial rally back to the 38.2% level. The eventual resistance, which you can expect, is 61.8%. That lines up with the 2024 high. So this breakout really is a significant breakout, not just getting above those recent highs, but on the weekly chart, really suggesting a retest of the previous highs as a reasonable expectation, given the fact that we've finally broken above that level. So holding that breakout level, holding that 150 or so level, I think unlocks the door to a retest for biotech. That's in healthcare, which has not been a particularly strong sector, but starting to show some strength there. All right, final chart, Omnicom Group, OMC. I was running my weekly exercise looking for stocks making new 3-month highs. This is an exercise I go through often to identify new emerging areas of strength. 2 names within communication services that I highlighted from my Market Misbehavior Premium members in our member community earlier today. One of those, OMC, Omnicom Group. You can see what I like about this. What I like about this chart, if you followed my work for a while, because I think it sort of captures a fantastic rotation from 3 phases: a distribution phase, a consolidation phase, and an accumulation phase. I like to keep things simple. For me, a distribution phase is a period of distribution, lower highs, lower lows, moving averages sloping downwards. That's what it looked like December of last year, January, February, March, into the April low. From April, May, June, July, we're in a sideways move or a consolidation phase. Highs and lows are fairly static. We have levels of support that hold. We have level of resistance that hold. We're basically in a sideways trend. And this is where the moving averages tend to flatten. It's where the momentum tends to be pretty neutral. So the RSI tends to be between 40 and 60. Now, I would argue we have a new accumulation phase. What marks that? Well, we start to make higher highs and higher lows. That consolidation that we saw earlier starts to get broken with some breakouts. The momentum starts to improve with the RSI pushing above 60. We break back above the 200-day moving average here. We've retested it from above and now bounced higher. So I like the upside rotation in OMC. And again, for me, it demonstrates some changes of character, distribution to consolidation, consolidation to accumulation. I like that rotation. It's a sign that investors are starting to believe, willing to pay a little bit more for the stock. All right, let's take a couple questions here. Yeah, we've got a number of questions about Fortinet, FTNT. Shall we take a look here? A number of you sort of had a little dialogue going on here. Rustin, thanks for watching on YouTube. You mentioned looks encouraging off of its lows so far. Someone else mentioned a potential island reversal. Interesting question. Let's take a look here. So this is the chart of FTNT. Would I call this an island reversal? I would not. Island reversal, there's not a great example on this chart that I see, but an island reversal would be like if you had, if this happened and then you had another gap up like this, and there was no overlap between this and the previous, level here, and then another level up here. That would be an island reversal. Island reversal is a gap lower, some action, a gap higher. So it's literally like you're looking overhead on a map, and you see this little island, right, jumping off from the mainland. Bearish island reverse would be a gap higher, some price action, a gap lower. So we haven't had like a second gap that kind of completes that. I don't think it's an island. I don't think you'd call it an island reversal at this point. Is it a constructive chart? For sure. I think what's most encouraging about the chart of F5 is probably easier to see with a candle chart. So let's do that. Look at what happened here. Whoops. Look at what happened here on the gap lower, right? We gapped down in early August. This was, earnings, which on August 6th here. So we gapped way lower on earnings, but look what happened, right? That low, around $70 a share, that's the lowest it's been. After the gap, we have a hammer candle on that day, which means during the day, we opened down here. We traded all the way down to 70, but by the close, we're back just above $75 a share. That shows you that investors, at least on day one, are really excited to buy Fortinet, FTNT, at a deep discount. It's like the Bed Bath & Beyond 30% off coupon, right? You basically have a 30% off coupon for a great technology company. People buy into it. Then you can see the fact that action is sustained because that's the low, right? We haven't even touched $70 from there. We've had a pretty nice pattern of higher highs and higher lows. In this sort of environment, I like to keep things super simple. Once you have a new uptrend established, I kind of go full trend line approach. There's your trend line. I don't need to make it thicker than ever. That's kind of what I would do, right? So you have the gap lower. You connect the trend line using the lows. As long as we hold this trend line, this is a beautiful recovery off of the after the gap lower. We break that trend line. That tells you that whatever lack of optimism fueled this gap, right? Earnings. We have another rotation below that trend line. That tells you more distribution. But until then, basically the story is accumulation off the lows. Other observation I would make here is the momentum just starting to improve, and I would say getting right up to 60. A breakout on stronger momentum, right? RSI starting to push above 60. Ideally, RSI getting up to overbought region. That's what a bull market starts to look like. So, again, we're still well below the 200-day moving average. This gap is taking quite a bit of time to fill, because that was a huge haircut from around 97 to around 75, right? From one day to the next. That's a big change. But from there, people have been accumulating, right? That's been the general, it's been more optimistic. So I think innocent until proven guilty off of those lows. I think that's an encouraging encouraging action there. I like thinking like a trend follower in that sort of environment. Let's see. Any other questions? 3P Investor, thanks as always for watching, my friend. You asked about Figma. Figma's an early name, right? So sort of a recent IPO. So we're going to zoom in a little bit. You know, at any time you're looking at an IPO chart, by the way, I would just remind you, I mean, what the reality is technical analysis is driven by data. So the more data you have, the more you can assess the conditions. So it's hard for me to project like a month out on the chart of Figma when I only have 2 months of data to work with. So I think you have to, you know, sort of keep your timeframes limited as a technical analyst, because while you can come up with reasons why we should be valuing the stock higher or lower down the road, I mean, I think the reality is for now, it's you know, from a technical perspective, there's just not a lot of data to work with. So what happened with Figma? Here's the IPO price, right? Was set just below, where was this, 33 or so. Day one, we open up here. So huge higher open, obviously on day one. Day two, a little bit higher. But then from there, following the classic kind of pump and dump IPO pattern, that's it. How many IPOs have we seen that have, you know, all the sort of private placement buyers, the people that bought in at a huge discount? Big institutions are thrilled. Any retail investors that got suckered in and bought after the huge gap higher, basically the institutions making a killing or selling to retail investors getting in, and then it goes down. This is why I generally, if not always, stay away from IPOs, because I've seen this happen so many times. What I have seen, though, are IPOs eventually kind of get a sense of stability. There's this huge gap between the IPO price and the day one opening price, the initial movement, which is obviously quite volatile. We're just starting to get a 21-day exponential moving average because we actually had 21 days of data to start with. We don't have a 50-day moving average yet because we haven't had 50 trading days yet. So we have limited data. So what do you have at the very beginning? All you have is support and resistance, right? Where is a level where you can see buyers coming in? Where is a level where you see sellers, you know, taking action? For now, I think we have a pretty good floor on the stock, which is around $50 a share. That was the, you know, the final low here, right? When we eventually found a floor early September around 50. We retested that level in early October, which means going forward, $50 is a pretty confirmed support level to keep an eye on. And we've broken above 60, which is encouraging. So initial breakout, I think that's pretty encouraging. Would I feel comfortable taking a speculative position on the break above resistance with a stop around 50? That's how I would generally structure it using the information that I have available. If I was actually trading the stock, can you guess what I would do? Zoom in, right? When in doubt, zoom out. We can't zoom out because we don't have any data because the stock just started trading 2 months ago. We can zoom in a little bit. This is one of those times, particularly out of an IPO. Look at an hourly chart. Look at a 5-minute chart. Look at a 15-minute chart. Look for patterns and levels of support and resistance on those shorter term timeframes. Eventually, we'll have enough data to build up a decent daily chart. Until then, let's make the best with the information that we do have available. I hope that's helpful. I hope you appreciated this run through the charts, this update on the markets. And I thank you guys, as always, those of you tuning in and asking some great questions along the way. We didn't get to some of those questions. We'll put them in the mailbag for our mailbag episode later this week. In the meantime, have a fantastic evening. I wish you all well. I wish better outcomes for my Seattle Mariners, currently down 3-8, as they've been getting hit on pretty aggressively during the show. But we'll continue on. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.